A Bitcoin ETF gives you exposure to Bitcoin's price through a regular brokerage account without requiring you to buy, store, or transfer Bitcoin yourself. That is the beginner-friendly explanation. You search for the product through a broker, purchase shares, and the value of those shares is designed to move roughly with the price of Bitcoin, after accounting for fees and normal trading differences. This removes several operational barriers. You do not need to open an account with a crypto exchange, choose a digital wallet, protect a seed phrase, or personally manage private keys. But convenience should not be confused with safety. The product may trade like a traditional ETF, but the investment underneath remains Bitcoin, an asset capable of experiencing large and rapid price movements. The wrapper makes Bitcoin easier to access. It does not make Bitcoin less volatile, produce predictable cash flow, or guarantee a profit. There is also an important technical detail. Although most investors call these products Bitcoin ETFs, U.S. spot Bitcoin products are generally structured as exchange-traded commodity trusts rather than traditional investment company ETFs. That distinction sounds technical, but it helps explain exactly what you own. So let's open the wrapper and follow the ownership chain. When you purchase a spot Bitcoin ETP, you are not purchasing a specific fraction of Bitcoin that is placed into a wallet registered in your name. You are purchasing shares issued by a trust. The trust owns Bitcoin through its custody arrangements, while your brokerage account records your ownership of the publicly traded shares. Economically, the objective is straightforward. If the value of the Bitcoin held by the trust rises, the value of each share should generally rise as well. If Bitcoin falls, the shares should generally fall. However, the share price may not match Bitcoin perfectly at every moment. Product expenses gradually reduce the amount of Bitcoin represented by each share. Market trading can also temporarily create a small premium or discount relative to the trust's net asset value. Another detail matters for investors accustomed to normal stock and bond ETFs. Spot Bitcoin ETPs are generally not registered under the Investment Company Act of 1940. Therefore, they do not operate under all the same statutory requirements that apply to traditional registered mutual funds and ETFs. This does not automatically make them good or bad. It means investors should understand the structure rather than assuming every exchange-traded product has identical legal protections. And the clearest difference appears when we ask who controls the Bitcoin's private keys. Direct Bitcoin ownership is based on control of private cryptographic keys. A private key allows someone to authorize transactions involving Bitcoin associated with a blockchain address. When people say, "not your keys, not your coins," they are emphasizing that control over the private key determines direct control over the asset. A Bitcoin ETF investor does not control those keys. The trust and its service providers manage the custody arrangement, while the investor controls only the brokerage shares. That means you generally cannot withdraw the underlying Bitcoin, transfer it to another wallet, send it to another person, or use it directly on the Bitcoin network. For some investors, that is a disadvantage because they want direct ownership and on-chain control. For others, it is the entire reason to choose the ETF. They do not want the responsibility of protecting a seed phrase, operating a hardware wallet, or dealing with the risk of permanently losing access credentials. The decision is therefore not simply ownership versus no ownership, it's direct asset control versus exposure through a regulated brokerage product. Both structures involve risks, but the responsibility sits in different places. And before deciding which structure fits your needs, you must avoid confusing a spot Bitcoin product with a Bitcoin futures ETF. They may appear similar on a brokerage screen, but the machinery underneath is very different. A spot Bitcoin ETF seeks exposure by holding Bitcoin through the trust's custody system. A Bitcoin futures ETF normally gains exposure through futures contracts, agreements whose value is connected to the expected price of Bitcoin at a future date. That difference affects performance. A spot product is designed to follow Bitcoin's current market price, minus sponsor fees and other tracking differences. A futures fund must manage contracts with expiration dates. Before one contract expires, the fund generally closes or settles that position and replaces it with another contract. This process is called rolling. The new contract may cost more or less than the expiring contract. When later dated futures trade above near-term contracts, the market is commonly described as being in contango. Repeatedly replacing cheaper expiring contracts with more expensive contracts can create a performance drag. Under different market conditions, rolling may help performance. The main point is not that futures ETFs always underperform. It is that their returns depend on the futures market structure, contract management, collateral, fund expenses, and Bitcoin's price, not Bitcoin's spot price alone. For a beginner seeking simple price exposure, a spot product is usually easier to understand. But even a spot product needs a mechanism that keeps its traded share price aligned with the Bitcoin it holds. That mechanism is where authorized participants enter the picture. A spot Bitcoin ETP has two important values. The first is its net asset value, or NAV. NAV is based primarily on the value of the Bitcoin held by the trust, adjusted for liabilities and divided across the outstanding shares. The second is the market price. That is the price investors are currently willing to pay for the shares on the stock exchange. During normal trading, the market price can move slightly above or below NAV. A price above NAV is called a premium. A price below NAV is called a discount. Large financial institutions, known as authorized participants, help reduce persistent differences through the creation and redemption process. When shares trade above their underlying value, the structure may create an incentive to introduce additional shares. When shares trade below underlying value, the structure may create an incentive to remove shares. This arbitrage mechanism is designed to pull the trading price back toward NAV. But tracking will never be mathematically perfect. Sponsor fees gradually reduce value. Bid-ask spreads affect trading. Bitcoin trades continuously while the ETP follows stock market trading hours. Pricing methodologies and market stress can also create temporary differences, so the ETP does not magically transform Bitcoin into a stock. It creates a bridge between the 24-hour Bitcoin market and a traditional securities exchange, and beneath that bridge, someone still has to protect the actual Bitcoin. With direct Bitcoin ownership, you may personally control the private keys, or you may allow a crypto platform to hold the asset for you. With a spot Bitcoin ETP, the custody responsibility is handled through the product's institutional structure. The investor owns shares through a broker. The trust owns the underlying Bitcoin. A designated custodian protects the private keys needed to control that Bitcoin. Custody arrangements may use cold storage, restricted access, multiple authorization procedures, cybersecurity controls, and operational systems designed to prevent unauthorized movement of assets. This solves a practical problem for many investors. They no longer have to personally manage a hardware wallet or worry that one lost seed phrase could permanently remove access to the investment. But custody risk has not disappeared. It has been transferred from the individual investor to the trust, custodian, broker, and other service providers. Operational failures, cyber attacks, internal control problems, legal disputes, and concentration among service providers remain relevant risks. Investors should review the prospectus to identify the custodian, understand how assets are stored, and learn how losses or service interruptions would be handled. Professional custody may be more convenient than personal custody. It is not the same thing as zero custody risk. And in 2026, the operational structure became more flexible because of an important regulatory change approved the previous year. When U.S. spot Bitcoin ETPs first launched, their creation and redemption processes were limited to cash. In a cash creation, an authorized participant provides cash, and the product's operating structure uses that cash to obtain Bitcoin. In a cash redemption, shares are exchanged through a process that ultimately produces cash rather than delivering Bitcoin directly through the creation and redemption mechanism. On July 29, 2025, the Securities and Exchange Commission approved in-kind creations and redemptions for crypto asset ETPs. Under an in-kind model, Authorized participants, or their designated agents, can use the underlying crypto asset as part of the creation or redemption process instead of relying exclusively on cash. By 2026, this gave product providers additional operational flexibility and made the structure more similar to other commodity-based exchange-traded products. The potential benefits include reduced transaction friction, fewer forced open market purchases or sales, and more efficient portfolio operations. But retail investors should understand what this update does not mean. You still cannot normally exchange a few ETP shares for Bitcoin and transfer it to your personal wallet. Creation and redemption occur in large institutional units and involve authorized participants, so this update improves the machinery behind the product. It does not turn the ETP into direct Bitcoin ownership. With the structure now clear, we can compare the practical trade-offs between using the ETF wrapper and buying Bitcoin directly. The Bitcoin ETF route prioritizes convenience. You can purchase shares through a traditional broker, view them beside your stocks and bonds, use familiar order types, and potentially hold the product inside certain retirement accounts. You do not need a separate crypto exchange account or personal wallet. The trade-off is reduced control. You cannot normally withdraw the underlying Bitcoin, move it on-chain, use it for transactions, or verify personal possession through your own private keys. You also pay a recurring sponsor fee. Direct Bitcoin ownership offers greater control. You can transfer the asset between wallets, use the Bitcoin network, and eliminate the ETF sponsor fee. But direct ownership introduces different costs and responsibilities. Crypto platforms may charge transaction and withdrawal fees. Market spreads can vary. Personal custody requires security procedures, and a serious mistake may be irreversible. Direct Bitcoin can also create additional operational complexity when held as part of a retirement strategy. The correct choice depends on the job you expect the asset to perform. Someone who only wants price exposure inside a diversified brokerage portfolio may prefer the ETP. Someone who values self-custody and on-chain use may prefer direct ownership. Neither structure changes Bitcoin's underlying investment case, and before analyzing fees and risks, this is the right moment to support the channel that focuses on those distinctions. If you prefer crypto explanations without price predictions, moon target, or panic-driven headlines, subscribe to Boring Money Wins. The goal of this channel is not to tell you that Bitcoin will replace the financial system next year or disappear next Tuesday. The goal is to explain how investment products actually work, which risks remain hidden inside the wrapper, and how each asset may or may not fit into a long-term portfolio. We cover ETFs, REITs, stocks, bonds, retirement accounts, and crypto with the same basic framework. Understand the structure, understand the costs, understand the downside, then make a decision that fits your own plan. If this video has already made Bitcoin ETFs easier to understand, click the like button. That helps YouTube recommend the analysis to more beginners who may be ready to purchase a product without yet understanding what it owns, how it tracks Bitcoin, or who controls the private keys. Now let's return to one of the most practical comparisons. Bitcoin ETP sponsor fees can look tiny when written as percentages, but the difference between products compounds over time, and the sponsor fee is only one part of the total cost. The first cost is the sponsor fee. This is the recurring percentage charged by the product and reflected in its performance over time. As of July 2026, selected U.S. spot Bitcoin products showed meaningful fee differences. Franklin's EasyBC charged 0.19%. Bitwise's BITB charged 0.20%. BlackRock's IBIT and Fidelity's FBTC each charged 0.25%. Grayscale's GBTC charged 1.50%. A 1 percentage point difference may not look dramatic during 1 month. Over a long holding period, it can create a substantial difference in the amount of Bitcoin exposure remaining for shareholders, especially because these products generally sell small amounts of Bitcoin over time to cover their fees and expenses. But the lowest sponsor fee does not automatically create the lowest total trading cost. Investors should also examine the bid-ask spread, daily trading volume, premium or discount behavior, brokerage charges, and execution quality. The spread is a trading cost, not another annual expense. Therefore, you should not simply add a 0.20% fee to a 0.05% spread and describe the result as a recurring yearly charge. For a long-term investor, sponsor fees matter. For a frequent trader, liquidity and execution can matter just as much. But even the cheapest, most liquid ETP still carries the risks of the asset underneath it. The most important remaining risk is Bitcoin itself. Bitcoin can experience extreme volatility, rapid drawdowns, speculative cycles, changing demand, regulatory uncertainty, technological risks, and shifts in market liquidity. The ETP wrapper does not place a floor under the price. It does not generate earnings, interest, rent, or dividends that can be used to calculate a traditional intrinsic value. There is also tracking risk. Sponsor fees, operating expenses, trading hours differences, premiums, discounts, and market disruptions can cause the shareholder's result to differ from Bitcoin's exact price movement. Custody and operational risks remain within the institutional system. The custodian, trust, broker, authorized participants, pricing providers, and exchanges all perform functions necessary for the product to operate. Trading hours risk is especially easy to overlook. Bitcoin trades 24 hours a day, 7 days a week. US ETP shares normally trade during exchange hours. If Bitcoin moves sharply overnight or during a weekend, the ETP may open with a significant price gap when stock market trading resumes. Finally, regulatory approval should not be interpreted as government endorsement or a guarantee that the investment is appropriate. The product makes access easier. It does not make Bitcoin conservative. That is why the account used to hold the position and its tax rules can materially affect the final investor experience. A Bitcoin ETP can be held in a standard taxable brokerage account, and some investors may also have access through a traditional or Roth IRA. In a taxable brokerage account, selling shares can create a capital gain or loss. The exact tax treatment depends on the product's legal structure, the investor's holding period, transactions, and current tax rules. Investors should therefore review the product's tax disclosures rather than assuming it will be treated exactly like every traditional stock ETF. Inside a traditional IRA, gains and losses from normal trading generally do not create an immediate personal tax bill. Taxes are normally deferred until distributions are taken, although withdrawal rules and potential penalties apply. Inside a Roth IRA, internal gains are currently not taxed, and qualified distributions can be tax-free when the legal requirements are satisfied. This can make the ETP wrapper operationally attractive for investors who want Bitcoin exposure inside a retirement account. But tax advantages do not improve the investment itself. A large loss inside a Roth IRA is still a real economic loss, and the unused contribution capacity may be difficult or impossible to replace. The decision should therefore begin with portfolio suitability, not tax excitement. Once the account is selected, the final risk management decision is position size, because even a simple product can create a complicated portfolio when the allocation becomes too large. There is no universal Bitcoin allocation that is appropriate for every investor. A 1% position may be irrelevant to one portfolio and emotionally difficult for another. A 10% allocation may look manageable while Bitcoin is rising, but it can become the dominant source of portfolio volatility during a major decline. Position size should be based on the downside, not the most optimistic forecast. Ask what would happen if the position lost half of its value. Would the overall financial plan remain intact? Would you continue holding, rebalance according to a predetermined rule, or panic and sell? Would a decline affect retirement timing, emergency savings, debt repayment, or other essential goals? A small allocation can provide meaningful exposure because Bitcoin is volatile. A large allocation can quietly transform a diversified portfolio into a concentrated bet on one asset. Advanced investors should also consider correlation changes. Bitcoin may behave differently across market cycles. It should not be assumed to provide reliable diversification during every recession, inflation shock, or liquidity crisis. The best position is not necessarily the maximum amount you can tolerate during a good year. It is an amount you can hold rationally during a bad year without abandoning the rest of your investment plan. With that principle established, we can finish with the 7 questions every beginner should answer before buying. Before purchasing a Bitcoin ETF, answer 7 questions. First, is the product spot-based or futures-based? Second, what does it actually hold? Bitcoin, futures contracts, another ETP, or a more complex combination? Third, who provides custody and what risks are disclosed in the prospectus? Fourth, what sponsor fee will reduce your exposure over time? Fifth, how liquid are the shares and what bid-ask spread are you likely to face? Sixth, will the position be held in a taxable brokerage account, traditional IRA, or Roth IRA? Seventh, how large will the position be relative to your total portfolio and financial plan? The final verdict is simple. A spot Bitcoin ETP can be an efficient tool for an investor who wants Bitcoin price exposure through a familiar brokerage account without personally managing a wallet or private keys. But it is not direct Bitcoin ownership. It is not a traditional low-volatility ETF. It is not a complete investment strategy. And it does not answer the hardest questions, whether Bitcoin is attractively valued, whether the risk fits your goals, and whether you can hold the position through severe volatility. The ETP solves the access problem. It does not solve the investment decision problem. Understand the wrapper, control the position size, and never confuse easier buying with lower risk. That is how boring discipline can survive even in the least boring asset class.